Right, hello, and welcome back to Camel Finance. I'm your boy Camel, and today I want to be making the case for a 5-figure gold ounce. If you're not already following us on Twitter, please do so, and of course subscribe to the channel if you haven't already. So let's get into this. I want to start with the technicals. We've got an enormous cup and handle, which I want to talk about. If you don't know what a cup and handle is, it's a chart pattern that looks a little bit like a teacup. We have this cup base forms a handle period of consolidation and then a breakout which leads to higher prices. This generally is a high performing pattern. In fact, it's ranked number 3 out of 39. So this is a very high performing pattern, so therefore it would be reasonable to expect that this pattern does resolve to the upside. I want to point something else out, the important thing to take into account here, and this is this old saying, this old adage of the longer the base, the higher the space. And what this refers to is the longer period of time that we spend forming this base, then the higher we can expect it to go. And also a long base leads to a much longer and stronger move when it does finally resolve. So with that said, pull this gold chart up. I've shown this chart a few times. Short term, I think we're still working on this breakout retest. It's in no man's land for me, short term, and it's Friday, so we'll be looking to see what happens on Monday. Not looking to take on any weekend risk unnecessarily. But the point I'm trying to make here is, if we go to a weekly chart and I zoom out a lot, what we'll notice straight away, hopefully, is we've got this enormous cup with handle pattern forming, and it's already broken out. So we could expect that this is likely going to be the start of an enormous bull market for gold. It's also worth noting, as I just mentioned, the longer the base, the higher we can expect it to go. This is, if you look at the date scale down the bottom, this is a decade long cup and handle. It's the largest one I've ever seen. Let me know if you know of a bigger one than this. I'll be really interested to see it. But given that this is a full decade, over a decade of basing, then I think it's more than reasonable to expect to see us move well up into this region here. And I'm going to be pointing to a few other factors now that back this theory up. First of all, I think we need to cover naked shorts and explain what has caused, why hasn't the price gone where it should have gone sooner. Originally, it was jewelers and goldsmiths that worked out this little trick. So many years ago, jewelers and goldsmiths would be the people that had the vaults, the security, the ability to store gold. And so what they would do is they would agree to store people's gold for them, since other people couldn't store it as safely and securely as these goldsmiths could. And it was the goldsmiths that worked out a couple of 100 years ago that not every single customer would come to collect their gold at the same time. So people would go to their local goldsmiths and hand over their gold and agree to store it in a secure vault. The goldsmiths would issue a sort of paper claim on this gold, an IOU, if you will, and then the people would take this IOU, their paper claim, home with them and be happy that their gold is being securely vaulted and looked after. Very quickly, the goldsmiths worked out that since not everyone shows up at the same time to collect their gold, they could actually spend some of the gold. And then when people came to claim their gold with their IOU, it didn't have to be necessarily the exact same piece of gold that they were given out of the vault. And thus this ability to have more claims on gold than actual gold, this sort of scam was formulated. Fast forward a bit to banks and bullion vaults, and they figured out this same trick. They could charge people for gold, for holding gold in their bullion vaults, and issue paper claims on this gold, but not actually have a one-to-one backing. So more than one paper claim on the gold can exist per ounce of gold. Fast forward a few years, and this becomes standard practice now. However, this has gotten well out of hand, and the paper to gold ratio might be as high as 109 to 1, meaning for every 1 ounce of physical gold that exists in the world, there are 109 paper claims to that 1 ounce of gold. I have here the source of this claim. Paper to gold ratio, you can see the sources, USGS, gold exchanges. So with all that said, the next thing I want to talk about is Basel III. What is Basel III? Well, Basel III is a comprehensive set of reform measures in banking prudential regulation developed by the Basel Committee on the banking supervision to strengthen the regulation, supervision and risk management of the banking sector. What did you just say, Camel? Yeah, I know. Why Basel III regulations are poised to shake up the gold market? Well, really, the point I'm trying to make here is that this is all to do with the net stable funding ratio. So what is a net stable funding ratio? So this is a liquidity standard that the banks must follow to ensure adequate stable funding to cover their long-term assets. This ratio is known as the amount of available stable funding relative to the amount of required stable funding, which should be equal to at least 100% on an ongoing basis. So as of now, I believe their funding ratio, they only need to hold somewhere in the region of 5 to 10% of physical gold to the amount of paper claims on this gold. So with these new implementation of Basel III, the net stable funding ratio will require them to actually hold a much closer number of physical ounces of gold per paper claim. So the point I'm actually trying to make here is that the number of claims on the gold, currently sitting at over 109 claims per ounce, should start to reduce. And this also means that they won't be able to just short the market and put selling pressure on the market without actually owning any gold in order to suppress the price longer term. It's also worth noting that under Basel III, under this new regime, physical or allocated gold, like gold bars and coins, will be reclassified from a Tier 3 asset, which is the riskiest asset class, to a Tier 1 zero risk weight. This puts it right alongside cash and currencies as an asset class. So we are moving from a speculative asset class to a hard currency, a hard form of money. It's worth noting as well, the implementation of Basel III has been deferred to the 1st of January 2023. It was supposed to go live at the 1st of January this year. But to be honest, given that they've got so many paper claims, 109 or so per ounce, I imagine that that's not something they can just suddenly fix. So they're probably going to have to do an awful lot of heavy buying of gold and try to get this ratio back under control. You can see that they are actually moving towards buying all this gold because as of in 2021, central banks continue to buy gold, and central banks across the world now hold more than 35,000 metric tons of gold, and that's about a fifth of all the gold that's ever been mined. So if the people debasing the fiat currency and the people that are in charge of this whole monetary system are buying gold, wouldn't it be smart to follow them, is my argument, or at least one of my arguments. So in summary, the implementation of Basel III is almost certainly going to reduce the selling pressure applied to the gold market and will ensure that there's a bid underneath the physical gold asset as these central banks continue to buy physical gold and add it to their reserves and to their balance sheets. What next? The US national debt. What is it currently? The US national debt is currently over 30 trillion. Yes, really, 30 trillion. That is a 3 followed by 13 zeros. 3, 6, 9, 12, 13. Let that sink in for a minute. That's trillion with a T. So how are they going to service this debt? Well, they could raise rates, and you can see, if you've been following the markets lately, you'll know that they have started to increase interest rates. The problem with this is the markets are too fickle, the stock markets are too fickle for them to continuously raise rates. As they do go through a rate hiking cycle, and they continue to raise interest rates, something will break, like the stock market, for example. And as stocks respond to this by crashing, the Fed, which holds an awful lot of assets on its balance sheet, those assets will depreciate, and then it will trigger an issue for the Fed, in that the Fed has a ratio that is mandated to maintain. It's not allowed to have a certain amount of debt relative to its assets. So as its assets depreciate as a reaction to the rate rises, they will violate their mandated ratio of debt to assets, and therefore they will have no choice but to reverse these rate rises, and therefore go back to printing more money, quantitative easing as they like to call it, and then pump that money back into the markets in order to prop them back up. So my argument here is that whilst we might see rate rises in the short term, all paths eventually lead to them having to print more money. And each time they print, this is exponential. They do not just print a little bit to get themselves out. Each time they have to print money, they have to print more money than they did the time before. That means that the Fed can continue to inflate the debt away. This is their only option, to print enormous amounts of money and to inflate their debt in order to make it more serviceable. And so the impact on gold is, when you have large, severe amounts of inflation, when you have hyperinflation possibly, gold, a hard currency that has a nominal inflation rate, you can't just magic gold out of thin air. It does have around a 2% a year inflation rate, because they are still mining it, more still comes out of the ground, but it is a far harder currency than paper currency such as the fiat system, like the dollar or the euro or the pound, and as such usually responds very well in times of high inflation. It's worth noting that with all of this said, price suppression and future inflation to come, this national debt clock has done some calculations, and we see that the dollar to gold ratio right now, based on the amount of printing that they've done, and if there was no price suppression at all, we should be at around $18,510 per ounce. And you compare that to today's price of sub $2,000, and I think there's an enormous opportunity here. The last point I want to make is that Russia is paving the way to a global gold standard. This has been in the news recently, that Russia has made a case for owning gold, and nobody really noticed. They announced that they'd backed their Russian ruble, so that it was backed by gold in the region of, I believe, 5,000 rubles per gram of gold. And this is going to have an enormous impact on the fiat system. Russia is happy to accept, has said it's happy to accept other national currencies, such as yuan, lira, or whatever else. Or they would be happy to accept hard currency, and that for them no longer means US dollars, this actually means gold. So the dollar ceases to be a means of payment for Russia, in their own words. It's lost all interest for them, and they even went as far as to call the greenback no better than candy wrappers, which it's kind of funny and it's kind of not, isn't it? But to be fair to them, 80% of all dollars in existence were printed in the last 22 months. They've increased their monetary supply from 4 trillion to 20 trillion. 4 trillion in January 2020 to 20 trillion in October 2021. So they really are, in a sense, worth no more than the candy wrappers that the Russians were referring to. If you can just expand the monetary supply, the total amount of fiat in existence, from 4 trillion to 20 trillion in 22 months, then how is that something that you can consider has a lot of value? You can see the Russian ruble here this is the dollar against the ruble. So as this goes up, the dollar is getting stronger and the ruble is getting weaker. And you can see that during the invasion of Ukraine, the Russian invasion of Ukraine, the ruble plummeted against the dollar, and it's manifested as this huge spike. But since then, the ruble has really recovered quite well, and this is because they have backed their ruble to gold, so it now has a stable value, and it has an underlying value to it as well. And I believe that going forward we are going to have to see some sort of monetary reset. So there will be hyperinflation, or at least severe inflation, that will destroy the fiat currencies. At least what they've always done in past history is, once the fiat currencies have become completely worthless, then they do a new system where they back their currency to gold, to give it actual value, and to harden up the currency to make it so that it has more value than just candy wrappers. So I want to just recap by saying, I think I have already mentioned this, but you can see, hopefully, with all the points I've made so far, you can see that $18,000 an ounce, it's a long way off where we are today, but in my mind, it doesn't seem unreasonable given the inflation. If they're going to continue to print, and I believe they are, because as I said earlier, they can only raise rates, for a short amount of time, and then they have to undo their rate raises, and then they have to print even more money to try to service their debt. There's no other way around them. They are completely trapped. They're not stupid, mind. I'm not insinuating they're stupid. They know what they're doing, and they are trying to deliberately destroy the fiat system and to hyperinflate everyone into poverty, so that we will have to ask them for handouts and rely on them to feed us. So if you want to avoid that, if you want to try to have some sort of financial independence and some sort of fighting chance of not having to count on the government handouts and the government to feed you and look after you, then buying physical gold is certainly one way to try to get through this reset without suffering as much as they want you to. So we'll end here as well. Bob Lucas posted this. This is 12-month candles, so each candle is a year. You can see it in times of severe sort of economic crisis and high inflation. Gold does really well, and that's exactly where we are today. We've just broken our cup and handle, a decade-long cup and handle, and it's now time. It's not just my opinion. Bob Lucas is also thinking this. So I think we're going to go a lot higher. And then I also found this, which I thought was interesting. I thought I'd show you this. This date, this chart was created all the way back in 1897, and it sort of was a predictive. It was sort of a crudish model to try to predict market cycles and when would be a good time to make money and when would not. And interestingly enough, the rest of this year seems okay, but this sort of suggests there's going to be a lot of blood next year in 2023. And given that gold does well in times of in hard times for equities and other risk asset markets, I see no reason that the stars seem to be aligning here. So I just thought that was interesting. Anyway, I hope you enjoyed today's video. If you did enjoy this, please let us know in the comments. Please subscribe to the channel. Follow us on Twitter. We post to both of these places every day. I'm your boy Camel. Take care.